All right, good morning, everybody. It seems like it's been a really long time since it was a normal market. Of course, I had a wedding anniversary and then the holidays, and we're back. Just kind of feels like it's normal again. We may even see a normal day in the market. Maybe. So on Friday, a lot of the institutions started to unwind a rate hike that they had started to price into the latter half of 2022. Um, it's another example of how they are different than us in their scope and in their perspective. With this new COVID, they had decided that it may affect how soon the Fed is going to hike interest rates. And since they had already started to price in that hike, they began unwinding what they had begun pricing in. So that sell-off, as much as it may have felt kind of violent or extreme, it may have felt like it was, I heard somebody call it a market correction. It wasn't a correction. It wasn't extreme. Heck, it wasn't even a bad day. It was just a normal day in the market. Now, if we start seeing the S&P make 4%, 6% in a single day, that would be extreme. If we come off of the highs by more than 10%, that would be considered a correction, right? There's actually metrics attached to that kind of language so that when you say things like a market correction, it means 10%. A bear market means 20% or more, right? It needs to be more than 20% or more. So, words matter. When you want to discuss the scope of that move, try putting into perspective how far we went. So, for an example, here is the S&P futures, and you can see that on Friday we had only barely left the range of what would be considered the weekly expected move. So on the whole week, that was how far it was expected to move within the week, and it only went a little bit outside of that. Just negligible, right? A minor amount. Now you can see that the size of last week and the expected move size of this week, yeah, it got a little bit bigger, right? And that's because these lines are developed based on implied volatility. So when volatility goes up, the size of the box goes up. That was last week's box. If we just take that box and set it into this week, you can see that there's still a lot of room left over, right? We almost doubled in the expected move. Now, this is a static measurement. Once it is locked into place, it's done, and it gets locked into place on Friday. If you're looking for a more current, what we call a dynamic expected move, just come over to the options chain and look for Friday. So December 21st, don't look at the EM, right? Make sure you're looking at, or don't look at the AM. So we need December. Wait, do I have a filter on or something here? Nope. We need the December 3. Something's up. So it'd be this one. 4 days away because today's Monday. There's Friday. It's $105 higher, $105 lower from its current location. Just kind of keep it in perspective like that. You'll be all right. Okay, so that's a dynamic expected move, meaning it is constantly and currently being updated. All right, so as usual, when we start the morning briefing, we want to come over and look at the calendar very first thing in the morning. It should be the very first thing you look at. What's on the agenda for today? Where do I need to be concerned when I'm looking to trade? I personally don't trade between 8 and 10 unless I'm specifically trading an economic event. Otherwise, I sit out. I'm usually day done by 8 a.m. anyways. So, it doesn't hurt my feelings to sit out and wait. We do got a lot of economic events on the table today, but a lot of the market reaction is going to be absorbing the news. It's not just the COVID news. You really have to keep track of that oil news too. All right, so we got the oil news, COVID. We still have the supply chain issues going on. There's going to be quite a bit of economic data coming out today. This isn't too bad, but this is a lot of data coming out. 8, 8:30, 10, 10:30, and 11:30. And the 11:30 is additional auctions, which means our lunch could end early and abruptly right at 11:30. Normally, we wouldn't expect a market to begin trending during lunch, but on a day like this, it absolutely could. Somebody asked me about a dead cat bounce possibility. If you're kind of new to trading, a dead cat bounce is when you have a market trending to the downside and it pulls back. In that pullback, we're trying to decide, is it really just a pullback? Is it pulling back before we continue lower? Or is it a reversal? And the pullback itself is called a dead cat bounce. Until it proves itself, we don't know for sure, right? That's one of the things we could say we don't know for sure. But my 2 cents, it's not a dead cat bounce. So why do I come up with that? The rebound that we're seeing is basically unfolding because the market has enough information that has come out since the COVID scare from Thursday and Friday that says that this new variant isn't off the chain, right? It's manageable. Apparently, a couple of the bio pharma makers out there says, if we have to make a new shot for this, no problem, right? One of the things that seemed to have really scared the market was the potency and the speed of how fast this new variant could move, and yet the firms are saying, hey, no problem, we got it. That seems to have really calmed the market down, and we're starting to get that lift. Now, remember, the fall wasn't some uncontrolled tumble down the mountain, right? They were unwinding a position from pricing in the rate hike. So are they done with that? Are they done unwinding their position? Well, they had really just started. That's one bit. And then two, they may decide to just wait, that they may not want to completely unravel that thing. And they may want a little bit more information about the variant, right? Now that things have kind of calmed down a little bit, I don't think this is a dead cat bounce anymore. If we were looking to continue the move to the downside, then it would prove itself out as a dead cat bounce. That this pullback that you're seeing would just be the Busby off the bottom of that range, and then we would continue the move down. that's not what I expect. Now, can it happen? Oh, absolutely, right? We have 3 scenarios that can unfold today. One is that we work to reclaim these levels that we were at last week. 2 is that we remain sideways. Sideways would be that we basically stay inside of yesterday's regular trading hours range. And the third scenario would be that we break through that range to the downside. Now, a sideways day means that we could maintain anywhere inside this box and it would not be considered a bad day, which means you could see the S&P fall right back down to 45.80 and it still wouldn't be considered bearish. It wouldn't be negative at all. It'd just be a sideways day. We are up on the day 0.75%. We could give it all back and just be flat on the day. It wouldn't be negative, right? So a little bit of perspective on where we're sitting and how it would be perceived. So those are the 3 scenarios. We can go up from here, we can go down from here, we can go sideways. Not saying anything new there, right? Thanks, Captain Obvious. But what's more likely? And that's a good way to approach the market. What's more likely? Well, it's very likely that we don't stay here, right? 1, we got all that economic news. And 2, a lot of people are buying the dip. If you read the news this morning from, various places from around the world, we can jump over and look at something like Germany or London, right? Either one of those, Europe, Germany. And what I seen over here when I came in and was taking a look around was that they went straight bullish over there last night. They were definitely buying the dip, right? And it just straight up tells you, while you were sleeping, it was tomorrow for them, right? They were up, they were working, they were getting things done. And what were they doing? Buying the dip. Now, that doesn't mean that we're just going to follow through seamlessly. There's going to be a transition. Our market still needs to absorb all of this news from the weekend. But we know what's been going on. Asia was flat and negative. They didn't really see it as an opportunity. And yet sometime between the Asian markets and the European markets, they really started to come around and the European markets were buying the dip. Now we may see that continue into today's price. This is a really good start, a really good heads up of what kind of day we could have. So it's very likely at the least that we're going to break the top side of that range, the RTH from Friday to the upside. Now, once we get above that RTH, which is a pivot point, then it's game on. That's going to be our new support level once we're above it, and we will be targeting these previous levels. There is no volume node here to deal with, right? So we should move through that very quickly. Now, of course, there are regular pivot points to deal with, just pivot minors. It's nothing, really serious. There are no trapped traders back here, right? Because we went through all of that. But there are trapped traders within this area because we haven't been back there yet, right? Anybody who thought that that was the rally point and tried to buy that, well, that didn't work out. Yeah. So trade one, if you're looking for one and you haven't had one yet, when the market opens and we come up to that first level, we're going to reject there. Now, whether it's going to be a soft rejection or a hard rejection, nobody knows, right? Bob's your uncle. But it's very likely that we're going to reject there. That's a high probability turn, even momentarily, that we would fade out of that spot momentarily before being able to break through it, if we did break through it and go to the upside. So there's a trade idea, right? I know it's not very big, it's 15 points, but it's $50 a point, right? Grab 6 or 7 contracts and get day done. So that's our top side move. We could go sideways. So we would stay in this box. And I think if we stay in this box, it's going to look a lot like Friday. disjointed, choppy, violent, some firms going long, some firms going short. It's what I call a lack of communication, right? We don't know who to follow on a day like this. Who's buying and who's selling. And it's like one firm is just calling up the other firm and saying, okay, Joe, I'm going to start liquidating if you're ready to start picking these up, and the guy on the other end, oh yeah, bring it on, Bob. And they just sit there and one side is selling it out and the other side is buying it in. There's nobody to follow. Now you take something like that and then you take something like this, right? There is only one kind of trading going on during that situation, selling. There are no buyers. That's pure 100% selling. Or here, it was all buying. One small spot where they took some profit. Profit taking did not mean somebody was trying to short this sucker. It was just profit taking. Consistent messaging, right? So if we don't get that upside break and we happen to stay in the range, it's very likely that we're going to have an inconsistent message today. That there are still going to be firms who want to go long and other firms who want to go short. And if you don't quite understand that concept, I've done videos on the COT report. I didn't bother to do one this weekend, obviously, because the report uses data from Tuesday, comes out on Friday. Well, the sell-off wouldn't have been included in the report. We would have been looking at what they were trying to do before the news came out. So it wouldn't have helped us. Right, so I didn't do a COT report, but you can find those. They're on the Bullish Bears YouTube. And I explain the different market participants that are out there, the different firms. So if we go sideways, we're likely to stay inside this range. And it's also very likely to be choppy and nasty, and I won't participate in it. I'll go find something else to trade. If we get outside of this range, you'll feel it. Right? It'll be across the board. It'll be in tick, trend, AD, market breadth, UVOL, DVOL. Everything will be lit up. We will be highly correlated to the downside of every index falling. It would take tech, finance, probably energy too. It won't be subtle. Right? If we break to the bottom of that, out of the bottom of that box, you won't have to ask where we're going. You'll feel it. It'll be lit up like a Christmas tree. Right? I talk about weekly options a lot. If you run a scan on Thinkorswim, there are over 600 companies or ETF combined that have weekly options. It's hard to look at 600 companies. This is an easy way to do it. And I'm bringing it up because I really think that people are sleeping on this. It's a very useful, very powerful tool. You can seriously look at 600 companies and get pointed in the right direction. So on those days where we can't really lean on the sectors, use this. Of course, if you have something like FinViz or, FinViz Pro, they have an absolutely phenomenal heat map. It's one of the best I've seen. What moves our markets? The dollar and the bonds, the dollar and the bonds, stocks versus bonds. Keep your eye on these two. This would be the dollar and the 30-year. I like the 30-year. If you wanted to add the 2-year or the 10-year, there's absolutely nothing wrong with that. I wouldn't take away the 30. I would add the 2 and the 10, right? That's just me. Keeping your eye on the bonds and keeping your eye on the dollar will often signal you early to something dangerous or extreme coming. They can warn you about reversals, market stalls, dumps. These two are the best indicator you could put on your chart, the dollar and the bonds. What moves markets? The dollar and the bonds. A lot of times when we're trying to figure out, can the S&P go up here? Can SPY go up here? Can the QQQ move from here to the upside? What makes them move? The dollar and the bonds. Keep your eye on these two. They're getting a little extreme. I've gone over it more than once how the bonds affect the market, but it's not a teeter-totter situation. It's not an inverse exact correlation, right? When you throw a ball in the air, it's coming down. Well, when the bonds go up or the bonds go down, it doesn't mean for a fact that the market's going to react in the other direction. Usually it means that, yes, not always. So don't instinctively, immediately believe if you see the bonds breaking ledge to the downside that you're immediately going to see a response in the S&P to the upside. The other one that you can add to that is the VIX. I like the VIX futures, but there are a lot of VIX products out there. Most of those VIX products, UVOL, the UVIX, VIX, 9-day VIX, take your pick. There's a lot of things out there. Just be careful. A lot of them are ETNs or ETFs owned by a company, and then they hire people to go in and trade that product to make it move. They're called authorized market participants, and they deliberately manipulate the price of the product. Why would you use that, right? So if you're not using the VIX or the VX futures, and you're using some alternate volatility product, at least make sure you know where the hell it came from and what it's showing you. Because if you don't understand that part, then looking at the darn thing isn't going to do you any good. Most of them look at the VIX futures, though, so no matter which one it is that you're looking at, it's still referring to this. I've got an entire school of volatility videos on the bullish bears in the Next Level library, 20 videos. Emerging markets are up more than 1% this morning. That is my risk on indicator. If we were bearish or in any way skittish around the world, then we would see this flat or even in the red. And it's not, it's green. It's up more than 1%. That's super bullish. This is a great kind of weather vane, right? You know how you hang flags outside and you watch the flag to see which way the wind is blowing? That's this. This is a really great tool, right? And it's free. I mean, you didn't have to buy it. It's a great tool. Just look at it. You know, you get up in the morning, where's the EEM? Oh, dang, up more than 1%. Feeling a little bullish. Technology, airlines, and that's not a surprise. Mean reversion alone would bring them back up. IBB and XLE, energy and energy. Now notice this energy, XLP, I guess it is positive. See, and that's why I don't like sharing that pre-market percent indicator. It's not perfect. You know, Thinkorswim doesn't really like us using pre-market measurements. And so, you know, most of the time this little pre-market percent does pretty good, but here's a perfect example of when it doesn't, right? And there's nothing I can do about it. But I shared it anyways because everybody was screaming, oh, I want that. All right. So it's positive too. That means both energies are up, technology's up, and then emerging markets. So let's take this and go somewhere else with it. S&P 500 filtered down to 100 names, looking at things in a pre-market change percent. I did adjust the color scheme a little bit. Kind of gets rid of that gray, right? So this feels very risk on. This feels bullish. You can see that there are some red in there, but not a whole lot of red. In finance, recognize a couple of those trading firms. Communications, I don't see Facebook on there. So it's not looking too bad, right? Facebook is over here, I guess. It's in technology. It always throws me off how some places will read it as one and some are reading it as another. So here's the S&P 100, and this is the S&P 500 filtered to look like the 100. Set it on change percent. That looks bullish. It feels bullish. Got a lot of names that are up more than 0.5%. Now, the good thing is when we say that, well, we can ask how many names are up in the S&P more than 0.5%. 44. 44% of the S&P is up this morning, 0.5%. That's bullish. The only other metric that I could use Better than that is how many names are up in the pre-market in the S&P more than 1%. 18% of the S&P is up more than 1%. That is straight up bullish. Right? So now let's flip it over and look at the Nasdaq. So here's the Nasdaq 100 pre-market change percent, no filter needed. Just to adjust the color scheme a little bit so we get that pop. We certainly got a lot more red here. Now, the Nasdaq 100 does not have financials, right? That's something to keep in mind when you're making the distinction between the S&P and the Nasdaq. A lot of the names are in both, but not financials. Now, when I bring up a grid like this, I'm looking for not just a particular name, but a name and its peer group, right? Is it a chip sector, EV market, pot stocks, blockchain? If it's energy, which energy, right? If it's finance, which finance? Banks, lending institutions, credit cards. So you want to kind of take it overall, right? And look to see if there's a particular weakness or a sector that is still bullish but hasn't ran, 1% already. Looking at the names that are negative in the Nasdaq 100, it's not a very long list, right? I didn't have to scroll to see all the names in red. It's not that bad. Jump back over to that screener though, and we can look at the Nasdaq, starting with 0.5%. How many names in the Nasdaq are up at least 0.5%? We'll just round up and say 40. So 40% of the Nasdaq 100 is up more than 0.5%. That's pretty good. Use a 1%, 21% of the Nasdaq 100 is up more than 1% this morning. It's very bullish. We would want to go in and look at what names are up. Well, after that sell-off Friday, it's almost across the board, right? It's a buy the dip fueled rally in almost everything. But what got hammered the most? For an example, cruise lines, airlines. What was favored well Friday? Well, Netflix, for an example, did really good Friday. So the things that did really good Friday, I probably wouldn't lean into today. Things that did really bad Friday, I'm probably going to be looking more at those. Mainly because we've got red to green today, right? And if you're unfamiliar with red to green, it's a daily chart trade trigger. You first find the thing to trade based on the daily chart. So here's, a daily chart of XOP. This is a red day. Well, we would want to find, this is FXI. We would want to find a red market that closed in the lower portion of that red candle. And then today in the pre-market has rallied or gapped up at least to where we opened on Friday. Like Facebook, for an example. Very small candle, closed in the lower portion of that red day. We would want to see it opening up at least where it opened Friday, and it would be better if it opened completely above Friday altogether, right? So there's going to be a lot of red to greens today. This is a red to green with an inside day because we're still controlled from Thursday's candle. That's a really nice setup. I think I may be watching Facebook this morning, especially if Facebook is still red when we get near the bell. Microsoft is another one, red to green, closed in the lower portion of that candle, coming up off of that support level. When it comes to your trend lines and your patterns, just keep in mind that move from Wednesday to Friday broke a lot of patterns, and that kind of leaves us stuck, right? Because now our technical analysis is going to be broken as well. And it's not because you're new that it becomes difficult, right? It's the fact that your patterns are broken. You'll hear that kind of language at stockcharts.com, or IBD talks about it when they're talking about performing technical analysis after a move like last week, right? Where news broke our patterns, and it's going to take a few days for those charts to heal. That's what I got, everybody. Be careful, be safe, have a good day. I will be streaming at the Bullish Bears at 9:15 as I usually do on a Monday, and I will see you all there.